What's up, everybody? It's Ryan Cox. Today we're going to get insider tips for first-time homebuyers from a mortgage loan officer's perspective. First, let's talk about how to get approved. Getting approved is based on three main factors, and that is your credit, your income, and your debts. In general, you want your credit score to be around a 620 or above to get the most benefits and options in terms of rate and loan products. You also want to make sure you have at least 3 trade lines or credit lines that are active and in good standing, and preferably you've had those trade lines at least 2 years. It's important to note that not only should these credit lines be in good standing, but also that you don't have any lates in the last year. Income. When it comes to income, you want to make sure that you've had at least 2 years of consecutive work history. That should be in the same industry, in the same role, or with the same employer. You want to show the bank or the mortgage lender that you have a consistent line of work that is likely to continue for at least 3 years to come. You're also going to want to keep track of your most recent W-2s. Most lenders are going to want at least 2 years of your W-2s. Not your tax returns necessarily, but your W-2s. You want to keep these on hand, and if at all possible, you want to make sure that your income is not decreasing from 1 year to the next. This is a red flag in a mortgage lender's eyes, and they're forced to calculate your income in a way that is not as beneficial to you as if you had an increase in income from 1 year to the other. Always be working toward in your job making more or getting more hours or getting higher pay or getting a raise from year to year. This looks really good when you're trying to get approved. If you're self-employed or you're a contract worker and you receive non-taxed income, make sure you keep your deductions to a minimum because your income is going to be calculated based on your net profit after your deductions have been made. So if you make a lot of money but you've also taken a ton of deductions, the amount of income that can be counted for approval is a very small amount. So you'll definitely want to consult a CPA at the end of the day, but definitely don't take too many deductions on your tax return. You'll probably have to pay more in taxes, but you'll have more income that you can count towards getting approved for a house. All right, let's talk about the cost associated with buying a home. My tip for this is to save, 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 and save some more. The costs for buying a house include mainly your deposit, your down payment, if you're required to have one, and then the closing costs associated with the loan, which are broken down to origination fees, title fees, prepaids, your escrow, your appraisal, processing fees, title insurance, things like that. We won't go too deep into that, but basically your closing costs are any fees that go into your cost of getting a home loan. Down payment is going to be 3 to 5% if you're a first-time home buyer, or if you're a second-time home buyer or you're buying an investment property, it can range anywhere from 10 to 25%. And then you have your deposit and moving expenses. So when you find a house that you really like, upon your offer being accepted, you're usually required to put in a deposit. That deposit is usually between $500 to $1,000. And then of course you guys know what moving expenses are. Moving trucks, movers, boxes, new furniture, cleaning products, everything that comes along with moving. Having broken that down, you can understand why it's so important for you to have money saved, even if you were not required to put a down payment down. Now, there are some insider secrets as to how you can eliminate some of these costs. There are ways to get around a down payment, and one way is to choose a loan option that does not require a down payment. Here in Kentucky, there is a loan program called a USDA loan. This is a no money down loan. It's based on you choosing a house that is considered to be in a rural development. You can actually Google USDA eligibility map and type in the address of the house, and it'll let you know if it's eligible or not. The USDA, which is, yes, the same people that make your meat, is to encourage the middle class to purchase homes in rural areas. Check to see if in your state you qualify for USDA, or if the property you like does qualify. This loan does have a little more strict requirements in terms of credit score, debt to income. There's another loan type called the VA loan, so if you are a veteran, active, or retired, then you can take advantage of the VA loan. That is no money down as well. There are also down payment assistance programs that I'm not going to delve too deep into on this video, but if you are a first-time home buyer, there are down payment assistance programs available, as well as if you are not a first-time home buyer. You'll need to talk to your mortgage lender to see if you can qualify for any of these and get assistance for either some of your down payment or all of your down payment. Now, when it comes to closing costs, there are some closing costs that you can actually negotiate or shop around. There are some closing costs that are categorized as closing costs that borrowers can shop for. Mainly, these are going to be your title fees or your hazard insurance. The title company is the place where you're actually going to sign your papers. They handle all the legal aspects of buying a house. But title companies have to compete for your business, and you can use that to your advantage. Call different title companies in your area, find out what their fees are, and use those fees to compete with the next title company to see if they'll go a little lower for you. Your title fees can always be negotiated down a little lower, or they can be shopped around. If a title company wants your business, then they can match a price of a competitor, or even give you a better one. When it comes to your hazard insurance, I definitely recommend that you shop this. Most loans are required to have hazard insurance, which is your homeowner's insurance. You can shop hazard companies around. Don't just go with the company that has your car insurance because you think it'll be a lower price, because you think they're going to give you a bundle deal. These are sometimes the highest rates. You want to go with a smaller company, or I definitely recommend an independent agent that can shop your business around and find the best rate. Now let's talk documentation. This is probably one of the most tedious parts of the home buying process. You are going to be required to sign the most documentation you've ever signed in your life. You're going to be required to submit the most documentation that you've probably ever been required to submit in your life. I'm going to tell you how to be the most prepared and gather your documents ahead of time so that it is really easy and simple throughout the process. You want to have 3 basic things: most recent 2 years of W-2s or 1099s. You want to make sure that you gather these ahead of time so that you have them. Tax returns may or may not be required, so just to be safe, keep your most recent 2 years of tax returns available as well. Gather your most recent 30 days of pay stubs and keep them together. Make sure it's the actual pay stub where the lender can see what your year to date is, what your wages are, how much you make per hour, what are your deductions, what are your tax deductions. All of that is factored into the approval process, so make sure you're giving a full pay stub and any pay stubs you received in the last 30 days. Last but not least, make sure to keep your most recent 2 bank statements. Not transaction histories, not what you pull up on the internet that shows you what you've spent. It's going to be your full bank statements. Those are going to be the statements that are issued once a month that show from the beginning of the month to the end of the month, or from the beginning date to the end date, all of your transactions. It's going to show if you've had any NSFs. It's going to have your name and your address on it, your dates, and you want to make sure you have your most recent 2. So your bank statements will show 3 things. 1, it'll show that you have the funds to close. It's going to make sure that you have money for your down payment, any closing costs. Also, you want to make sure that you don't have any large undocumented deposits. A large deposit is anything that's considered 1% of the purchase price. So if you're buying a house that is $100,000 and you have a deposit that is $1,000, it is considered a large deposit. You can have large deposits as long as you have documentation for them. So say you have a large deposit that's a tax refund. As long as you can document where that money came from through your tax return or other documents, that's fine. If you cannot document where that money came from, say it's cash or you put cash into an ATM, that's not going to work. The underwriter is going to count that money as not even being in your bank account. So if you're needing $1,000 to get approved for your home loan, then that causes a big problem. So in general, you want to avoid large deposits altogether. You also want to make sure you don't have any NSFs or insufficient fund fees or return check fees. These are red flags to a mortgage lender, and if they do see any NSFs, they're going to ask for documentation as to why. You want to make sure that it's a very detailed explanation and that it's plausible, or else you might be putting yourself at risk of having your loan downgraded to a more difficult kind of loan with higher rates potentially, with more documentation required, or you might put yourself at risk for not getting approved at all. So that should be a good start for you for now. If you have any other questions, make sure you reach out to me. I'm always available. So everyone out there, have a great day. Remember that trust is key. Now get out there and be somebody.